Here's a number that shouldn't exist. Last year, this company earned about $5 million before tax and paid more than $29 million in income tax. That's an effective tax rate of roughly 592%. The company is TerrAscend, a multi-state cannabis operator, ticker TSNDF. And that absurd number is the whole story. TerrAscend is not a small operation. Net revenue was $260.6 million in 2025, at a gross margin above 52%. Revenue climbed to a peak near $317 million in 2023, then came down as the company exited Michigan and New Jersey, prices compressed. On a continuing basis, it was essentially flat, down under 3%. In a year, the whole U.S. market shrank. So why the loss? Look at the tax line. Operating income was $42 million. Interest expense ate almost $29 million, 11% of revenue. That left just $5 million of pre-tax profit. And then Section 280E took $29.5 million in tax, a bill nearly 6 times pre-tax income. Section 280E is a line of the federal tax code that bars any business trafficking a schedule, one drug from deducting normal expenses. Rent, payroll, marketing. Only cost of goods counts. So a profitable dispensary is taxed as if those costs don't exist. The 10K's own tax footnote puts the cost of that one line at $26 million. Strip it out, apply a normal rate, and the tax bill collapses from $29.5 million toward just a couple million, flipping a $24 million continuing operations loss to a small profit. Here's the tell that the loss is mostly on paper. TerrAscend has now posted positive operating cash flow for 15 straight quarters. In 2025, it generated about $68 million of adjusted EBITDA and roughly $25 million of free cash flow, while reporting an $81 million GAAP net loss. When a company prints cash and reports a big loss, the loss is about impairments and the tax code, not the business. And here's the bill that's still pending. By betting that 280E doesn't apply, TerrAscend has stopped paying part of that tax and built up an accrued back tax liability of about $139 million. That's more than half its market value. The Department of Justice is already suing to claw back an earlier refund, and the IRS is examining 3 years of returns. The medical fix does not erase any of it. The boom-bust scar is still visible. TerrAscend rode the 2021 capital cycle up and paid for it. In 2022 alone, it wrote off $311 million of goodwill and intangibles, driving a $325 million net loss that year. Cumulative write-downs since the peak total roughly $400 million, a near-complete erasure of boom-era acquisition value. Now, the catalysts, and the switch is already half-flipped. On April 28, 2026, the government moved medical marijuana to Schedule 3, which begins lifting 280E on medical income. TerrAscend's entire Pennsylvania business is medical, so some relief is live now. The larger adult use slice waits on a broad order from a contested Drug Enforcement Administration hearing. Meanwhile, management set an August 24th shareholder vote to prepare a U.S. exchange uplisting. The chairman says it's no longer a question of if, but when. So what's it worth as a normal business? Today, the stock trades near 69 cents, about 7 times EV to EBITDA and under 2 times revenue. Consumer staples peers that sell legal intoxicants, like Constellation Brands and Altria, trade around 10 to 12 times. Put a 10 to 14 times multiple on TerrAscend's $68 million of EBITDA, and the implied equity value works out to roughly $1.20 to $1.90 per share. These are implied values under stated assumptions, not price targets. Stack the scenarios and you get a band. A base case that keeps 280E points to about today's price. A partial catalyst case points to roughly 85 cents to $1.20. A full catalyst case, broad rescheduling, Pennsylvania adult use, a clean uplisting, points to roughly $1.40 to $1.90. At 69 cents, the market is pricing the base case and paying almost nothing for the catalysts. So here's the framework. The bull case is leveraged to a tax switch that's already turning. Every point the effective rate falls drops almost straight to the bottom line, and a clean uplisting re-rates the whole structure. The bear case is that it turns slowly. The $139 million back tax bill comes due. New Jersey keeps compressing, and a big 2028 debt maturity forces dilution first. Watch the effective tax rate, the August vote, and free cash flow against that maturity. We're not telling you what to do. We're showing you the math nobody else is. This entire analysis was built using RoboSystems, an open source platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. You can set up the same tools I just used in about 5 minutes. Head to robosystems.ai to get started. Link in the description.